Today's guest is actually one of the most successful mining executives you're ever really going to have the opportunity to listen to on interviews. That's David Garofalo. He's a returning guest here. He is actually was running Gold Corp, which actually ended up being the largest merger in the history of the precious metals industry, which sold to Newmont for, I think, at least, was it $32 billion? Is that what you guys sold it for, David?
That was the combined value of the company at the time, but Newmont's multiples of that now. And so it's been a big value added, really addition of the portfolio for Gold Corp shareholders at the time.
Fantastic. So today's guest is, one of those very successful and special individuals that's going to break down gold, what's going on in macroeconomics, and of course, going to end is going to give us some great business advice that could help you make more money over the next year. So make sure you smash the like button on this video. David is the CEO of Gold Royalty Corp. That is GROY, which we will link the website to right there down below where you can learn more. Give us a comment down below with your 2022 inflation predictions. Oftentimes I'll say, during the New Year's a gold or silver prediction, but they just came out and said Federal Reserve said inflation 7%. What's your thoughts on that?
I think it vastly understates the reality, because if you're putting food in your stomach, gas in your car, or putting a roof over your head, inflation's far in excess of that, is double digit comfortably. You buy a house in an urban center, you're paying 30% inflation year over year on house prices. It's hitting us in the pocketbook from every angle. And of course, that's the case given, over a dozen years of easy money, really going back to the last credit crisis. And that's just a barometer of what's been going on, the excesses that have been introduced into the system to deal with excessive debt. There's been so much debt strapped on. These governments are basically debasing their currencies in order to deflate the debt.
You've been saying double digit inflation for a while, really before the majority. I would say everybody realizes there's inflation right now. And you've been saying before everybody realized, and you've been saying it's double digit. I certainly agree with you that it's higher than 7%, but it is amazing to see them even throwing out a number that high, knowing how jerry-rigged their math is on how they run those stats. But you said that it's due to this incredible amount of money printing and inflating the debt away. What's shocked me, and if I try not to think about it, but it is a little frightening how quickly it's picked up. Why do you think it's picked up so quickly? I would say, especially over the last 6 to 12 months. And where do you think it's going?
Well, I think it's been amplified by all of the supply bottlenecks that have been introduced in the system over the COVID crisis. So that's been kind of an accelerant. It's been kind of like putting fuel on the barbecue, right, and getting the fire starter going. And they can't hide the excesses anymore. And now, it's hitting core products in our basket of goods that they can't hide away anymore. They can't exclude it from the basket anymore. And so I do think that we're going to be in an inflation cycle not unlike what we saw in the 1970s. That was fueled by high oil prices and excess money supply by high oil prices. This has been entirely fueled by excess money supply, by the introduction on a coordinated basis of excessive amounts of fiat currency into the market, really since the credit crisis, in order to stave off financial ruin and the collapse of our financial systems back in 2008, 2009.
I started this particular channel right around March 2020, and we were talking about a lot of these things. You've been on a lot, and you've been saying for a while you think double digit inflation, and I would see a lot of comments. It was like, oh, doom and gloom conspiracy, were the kind of things that it was categorized as. And it really is here in a major way. I went into Chipotle here in the United States yesterday, and they have beans and guacamole shortages. I'm seeing them everywhere. And my guests have been talking about that for a long time. And it's kind of coming full steam in a way that I can't say I like very much, because I don't know how they're going to fix the supply chain shortages. And when they're printing all of this money, you compared it to 1970s, but they really can't raise interest rates. And I wonder, what do you think they're going to do? And if you think they're going to do nothing, how do you think this compares to the 70s when you can't significantly raise interest rates without probably creating massive death, poverty, and starvation on a global scale, even worse than before? But what do they do, and what do you think happens?
Well, I think what they will do and what they should do are different. I mean, what they
Yeah,
will do is they'll go through the motions of raising interest rates. So you'll see
yeah,
25 bip jumps in the Fed rate, every quarter for the next little while. But the reality is, with inflation picking up, real interest rates will continue to actually go down. We're already decidedly into negative territory, with interest rates below 1%, inflation, at least headline inflation at 7%, real interest rates are well into negative territory, and inflation will outpace rises in interest rates. What I don't see at this point in the cycle is what we saw in the late 1970s, which was a Paul Volcker at the Federal Reserve. And Paul Volcker was very serious about taming inflation. And he did start to raise interest rates. And 2 years into that interest rate tightening cycle, that's when we saw gold peak. That's when interest rates got to exceedingly high levels, and we saw gold turn at that point. But the rise in interest rates, tightening by the Federal Reserve, is not the beginning of the end for gold. It's the beginning of the beginning. It's when gold really starts to take off, because real interest rates will continue to be negative. And the reality is, inflation will eat away at your capital, eat away at your savings. And the way to protect it is to be in the one currency you can't print, that preserves your capital, provides defensive mechanisms in a market that's likely to be correcting in the general equity markets. When we're seeing capital roll in your savings accounts, this is the place to protect your capital, in my view.
Okay, I want to talk a little bit about real rates. Something Rick Rule has always said is he'll begin selling out of gold um, when there's a significant shift in real rates. And you do hear a lot of people saying, well, commodities and gold, if they raise rates, they're going to get smashed. But you're saying if inflation is moving quicker, the real barometer is going to be real rates. Can you talk about that and just previous cycles where you had this scenario? Because in precious metals cycles, this seems to be a common thing, correct?
Yeah, and again, I go back to from that 79 to 1981 period, where Paul Volcker started to really rein in the excesses in the system, raise interest rates, but inflation was still galloping. It takes a couple of years for those real interest rate tightenings, to have an impact on the inflationary cycle in a positive way. And so that's what we're going to experience here. The motions that the Federal Reserve will go through in terms of tightening nominal rates will not have an impact on inflation for many, many months and likely years. And so I think those excesses will continue to perpetuate themselves for at least a couple of years. So we're at least a couple of years away from peak gold in terms of pricing. I think we're a long way from there. And I go back to my prediction before the last time I was on with you, Jake, is I do believe gold will exceed the real all-time high of $3,000 an ounce, which is really the 1981 peak adjusted to today's dollars.
So, as someone that's been studying this market for a while, and you could call some people a gold bug, but you're much more than that, because you're someone that's also very successfully navigated these financial markets and these businesses and these cycles. And so I think you're a good person to answer this question. Is, if you're not seeing that significant movement from gold in an environment like this, what makes you believe that along this continued trajectory of inflation and this Fed's dance between rates, what makes you believe that you will see this movement in gold?
Well, there's so many excesses in the system, so many yellow and red flags out there, that eventually capital will flee to gold, and that those excesses are manifested in debt levels, in general equity levels, which are at all-time highs in terms of price to earnings multiples, price to cash flow multiples. Lots of excesses in the system. There's likely to be a very, very severe correction, and then capital will flee to places where there's scarcity. And gold is a scarce commodity, a scarce currency, and has been for millennia. There's very finite quantity of it. There's very little of it. New gold being introduced in the system. There's inelasticity of supply to price. This is the definition of scarcity. where everything else is paper, it's zeros and ones, and can be introduced willy-nilly into the system. And that's why we have the excesses we have now. So gold will move. And when it does, it will be a violent move. It never goes up in a straight, steady line. It's always an extremely violent move upwards and downwards for that matter when the cycle turns. And when sentiment turns, it becomes a wholesale turn in the market sentiment. And you're going to see that reaction in the gold price inevitably.
Now, before we get a little bit more into mining stocks and we talk a little bit about Gold Royalty Corp, here's from a macro perspective, here's one final question that I have for you that I'd love to know. I know you think about this because I sit back and you liken this to the 70s. Many very intelligent people have said that they can't raise interest rates much, maybe more than a little basis point here or there, and then have to move backwards and things like that. So I don't know how they tame inflation in the way they did in the 70s. And another thing is we didn't have such incredible supply chain disruptions, and they're really bad. And if you study Venezuela, if you study Zimbabwe, if you study any places that have had a collapse, either of society or of currencies, one of the non-monetary things that you see occurring, people see inflation, but one of the non-monetary things is you see these disruptions in supply chains, and in a lot of places they're quite bad. In the East Coast, I've seen a lot of videos and photos of grocery stores very empty, and I don't know how they're able to keep this from getting out of control. And you can't just raise rates like you could in the 70s. And I just wonder, maybe they kick the can down a little bit longer, but eventually, what do you think they're going to do, or what's going to happen? Are they going to have to introduce a new monetary system? I mean, what? Because we're at this point where you're not seeing the food, you're seeing the inflation. I mean, everything from houses to cars, it's getting insane on pricing, and most people's wages are going backwards, not forwards.
Yeah, look, in history, they say history doesn't necessarily repeat itself, but it rhymes. And there's a lot of similarities between what we're experiencing today and in the 70s. And there were supply bottlenecks in the system because back in the 70s, far more than today, our economy ran on oil, far more. And so we had an oil embargo. We had people lining up at gas stations to fill up their car. We're having that now. We've had that now. We've had bare grocery shelves because truckers couldn't get the fuel to get stuff to the grocery stores. The 70s bear a striking resemblance to what we're experiencing right now in terms of supply bottlenecks for slightly different reasons, but the same sort of phenomenon is occurring. So we are seeing a lot of similarities to what we saw in the last inflation cycle. All of those excesses are starting to manifest themselves in very eerily similar ways. And so I do think it ends, frankly, when we get a Federal Reserve chairman that's actually serious about taming inflation. And honestly, it puts us into a nuclear winter in terms of economy, like happened in the 80s, where we had a long, long recession. Real estate prices were flat, wages were flat. It was very, very painful correction in the economy. And why wouldn't we experience that again? What makes us different than our forefathers back in the 70s and 80s? We're going through the same sort of dynamic.
Yeah, it's going to be interesting to see what happens. Doug Casey talks about a couple important philosophies for this type of a bizarre environment, and one of them he talks about speculation. One of them he talks about producing more than you consume, and we'll get to the latter here in a moment. But let's start with speculation. Doug says, you've got to turn into a speculator. So let's talk a little bit about mining stocks as one of those vehicles, and then tell me why, after selling your company, your biggest merger in all of the gold market history, you could have done anything. Why did you decide when you re-entered in terms of mining stocks to focus specifically on royalties?
Well, look, I don't like what inflation will do to our business. And I'm talking about mining writ large. I'm very concerned about input cost inflation, not unlike what we saw 10 years ago when we came out of the credit crisis and gold and base metals were running. We're in the middle of the Chinese super cycle. And we actually saw mining equities severely underperform the commodity price because of cost inflation. And that was against a backdrop of virtually no inflation in the general economy. Today, we have double digit inflation in the general economy. And we have a similar dynamic in the mining business with metal prices doing quite well. Base metals are at all time highs. Gold is, I would argue, at incentive levels for new mine development. I think there's going to be a catch up element or catch up trade in the mining business in new mine capacity, expansions, construction, because they haven't been investing in the ground to replace depleting reserves, which are down about 40% over the last half a dozen years. And so we're going to have general inflation driving up input costs, and we're going to have this competition for scarce resources to build new mines, which will further amplify inflation in the industry. It makes me actually kind of bearish on the mining equities, the producers. And that's borne itself out over the last year or so. Mining equities have severely underperformed the commodity. And that's because the market's discounting this inflation and the impact it'll have on margins. And so that's why at this point in my career, I've positioned myself in running a royalty business because I'm a big believer in gold. I'm extremely bullish on gold. But the question I ask myself is, well, how do I best play that? It's not by running mines. It's by actually taking a piece of the revenue, the top line, if you will, without any exposure to input costs. And that's the beauty of the royalty business. We just get that top line exposure. We have optimum leverage to the gold price. And we have leveraged the exploration success because these royalties are not only on existing deposits, but any expansions geologically that the underlying operators realize through their exploration efforts. And so it gives you optimum upside to the gold price, optimum upside to exploration with zero exposure to input costs. And that's why I think the mining equities will underperform the commodity, and the royalty companies will significantly outperform the commodity, which is exactly what happened 10 years ago. The producers went up about half of the increase in the commodity. Gold was up 140+%. The producers went up 60 to 70%. The royalty companies went up about 350% 10 years ago. So they outperformed the commodity. They provided that leverage. We're going to see a repeat of that phenomenon through this cycle, in my view, at this point.
How much of the input cost from the move in inflation can you actually hedge against with a royalty company? Yours is Gold Royalty Corp, but how much can you really how about your company specifically? How much can you really hedge against that?
Well, we don't have any exposure to those costs, so we're completely hedged, because we're taking just a percentage of the top line of the revenue from the mine. So we're helping to finance the construction and development in these mines by putting capital into them and taking our royalty back. And so really, it's the operator that absorbs all of the risk associated with input cost inflation, capital cost inflation. And that's the beauty of the royalty model. We're 100% hedged against those operating costs going up.
Yeah, I've had many individuals, yourself and many others, talk about the royalty business, and it's always interesting and catches people's eyes. But I guess it's another thing when you see the thesis behind it really playing out in real time, as we're beginning to see right now.
Yeah, exactly. And I believe that we're going to have again a repeat of the phenomenon we had 10 years ago, where the royalty companies vastly outperform both the commodity and the underlying producers, just because this cost inflation is being discounted in the market right now. You're seeing it in the mining equities and how poorly they've performed, in spite of the fact that the gold price has actually been quite solid, around $1,800 an ounce over the last year or so. The equities have steadily degraded and seen their multiples go down quite dramatically over that period of time.
Now, we had our first conversation shortly after Gold Royalty Corp was out, and we've been following the trends. Give us an update. What's going on? What's the goals for 2022?
Sure. Well, we've been a consolidator in the space. We started with our IPO just in March of last year, so about 9 months ago, and we raised $90 million US and achieved a post-money valuation of $200 million US with only 17 royalties in the portfolio. There were good royalties on some development stage assets, But we got a currency that we were able to use to start to merge with some of our peer companies. We acquired Ely Gold, which was a merger of equals back in the spring, and that allowed us to double in size and increase our royalty portfolio from 17 to over 100. And then we announced a three-way merger with Golden Valley and Abitibi, which further increased our royalties to over 190, exclusively in the Americas. 75% of those royalties concentrated in the two best jurisdictions in the world, Nevada and Quebec, for gold mining and prospecting. And we've now got 6 cash flowing royalties, and we have 7 in construction, which gives us an enviable upward trajectory in cash flow over the next 5 years. And that's given us the confidence just this week to introduce a dividend. We've announced a dividend of 1 cent per quarter per share. That gives us just under a 1% yield for our shareholders. And that's remarkable when you consider we started from a standing start 9 months ago, that we already have a sustainable enough business to pay a regular dividend to our shareholders. And given our prospects for cash flow growth over the foreseeable future, we see the prospect for further dividend increases over time.
Fantastic. So let's talk a little bit about, we've talked macro, we've talked about gold. Let's talk a little bit about the second phase of what Doug Casey was discussing, and that's producing more than you consume and saving the difference. What's some important, you're someone that's achieved a lot in business and been around a lot of successful individuals. What's some of the important money philosophies that you think are going to be guiding principles to navigate these turbulent times?
Well, I think ultimately, as a mining industry, we have to recognize that we're, at the end of the day, a collection of finite life assets. And the industry is vastly underinvested in itself over the last half a decade or so. And that's resulted in depleting reserves and depleting production profiles across the industry. And that's driving M&A among the producers, because if they're not finding it, they're going to have to buy it. So they're buying other companies in order to replace those depleting reserves and production profiles. And that plays very well into our strategy, because really ultimately what a royalty company is a specialty bank focused on financing new mine development and exploration. Given the need to catch up for underinvestment in the industry, we expect to be very busy providing capital to the explorers, producers, developers to finance the construction of new mines. That presents tremendous opportunities for further growing our cash flow and earnings on a per share basis as we deploy that capital, expecting to get double-digit rates of return.
You've been talking about an underinvestment in exploration and development for quite some time, and that's another theme that, since we began discussing, you're starting to really see come to fruition. Can you talk a little bit more about that?
Well, it's led to some fairly significant mergers in the space. Kinross just acquired Great Bear to introduce some growth into their portfolio. That's a huge new prospect in Northern Ontario. Agnico Eagle in Kirkland Lake. This is probably the second biggest gold merger that ever occurred. Announced their decision to combine late last year, and they expect to complete that transaction in the next month or so. So again, facing depleting reserves and production, we're seeing an acceleration in M&A in the producer space to replace those depleting reserve and production profiles.
Fascinating. So what do you foresee right now in early 2022? Seems like they announced inflation 7%. Nobody knows what to make of anything. It's like people are wondering, is the market going to crash? Are you headed to a next round of money printing? What is your expectations here from 2022?
I expect that there'll be a severe correction in the equity markets. There's far too much excess in the system. And I think, nominal rates going up is going to be somewhat of a tipping point for that. I see excesses in valuations generally. And I don't mean to dismiss cryptocurrencies. I think they're here to stay. I think that's an investment class that's extremely important. It's important for the modern economy to have digital currencies. But I think the volatility that's introduced into the system will have to get tamed over time. And I think ultimately what will happen is central banks will start to domesticate digital currencies and digitize their own currencies, because they can very well not allow renegades, for lack of a better term, to basically abdicate or abdicate responsibility for currencies globally to non-central banks. So I think eventually you're going to see a return to more rational valuations for cryptocurrencies. Cryptocurrencies are here to stay, but I also think that there's going to be competition from central banks for the market share that they've captured in terms of currency for transactions and whatnot. So I just think there's a lot of excesses in the system that are eventually going to result in a reset of valuations and hopefully a reduction in volatility over time as we see a correction in the marketplaces generally.
Earlier, you were talking about that you said a severe correction and then a movement of capital. Is that what you're referring to? A severe correction, 2011, 2020, and then there's a movement of capital and likely a Fed response. And you're saying that's when you think there's a big next movement up in commodities?
Exactly. Look, commodities are finite, paper's infinite, right? There's only so many commodities out there, very finite in quantity, difficult to develop a remarkable inelasticity of supply to price. You can't just flick a switch and produce more gold and produce more copper. But what's clear is our economies need both of those metals. We need copper to decarbonize our economy. Increasingly, we need gold as a preserver of capital in a volatile market, in a lower interest rate environment that's here to stay for the foreseeable future. So I do think that you're going to see a redeployment of capital into those hard assets in response to volatilities in the general equity markets and in paper-based assets.
Yeah, it's going to be interesting to watch. One thing is for sure, if we continue to see this movement inflation, we should continue to see a movement of money into commodities. We want to thank you for coming on today, David. David is with Gold Royalty Corp. We'll link the website right there down below. That's GROY is the listing. David, where can we learn more and anything else that I missed?
Well, it's goldroyalty.com. Easy to remember. Please visit our website, and we'd be delighted to share developments in our business with you through the website and our quarterly conference calls. Just watch the space. We have lots of news coming on through the market on our various assets that we have royalties on. There are dynamic assets still growing geologically, and so we'll provide quarterly updates on that. But we're very excited to have launched our inaugural dividend this year, or this week, I should say.
Fantastic. Congratulations on all the positive movements in such a quick period of time. For everyone listening to today's episode, give us your top ways to prepare here in 2022 for these rather interesting times. Let us know in the comment down below. What's your formula? What's your system for preparing? We'd love to know. Make sure you hit the like button, subscribe, bell notification. You get notified for new videos. And be sure to check out Gold Royalty Corp right there down below. I want to thank you for coming on, David.
Thanks, Jake.